Many of you have asked me for an update on Celsius. The stock is down 41% year to date. It's really, really bad. So I'm going to talk about Celsius today. I'm also going to be talking about AppLovin. This is another popular growth stock that's been going down like crazy. I'm going to give you my opinion on both of them, but especially Celsius because I've been following it for a while. And I'm also going to give you an investment idea, you could say, later on in the video. So I really hope you enjoy it as always. Now, if you look at the Celsius income statement as of the recent quarter, it was absolutely terrible. Revenue growth for Celsius was only 11%, guys. The company grew on a half, so over the last 6 months, about 50%. So this is a massive deceleration quarter on quarter growth for Celsius, 11% growth is very disappointing. Now, the disappointing part of the report, for me personally, was the international growth, because we all know that the Celsius brand has somewhat peaked in the United States. Every store we go to, everyone knows Celsius. So I thought they could take this business model and they can expand it internationally, and international growth would fuel the growth of Celsius. But this is not happening so far, as international growth is only 10%. I couldn't believe it, because it's only a $24 million base. The US base revenue is like 740 million. So I thought from the small base, they should grow 50%, 100%, 150%, not even 10%. That's really bad. They expanded in so many countries in Canada and other jurisdictions, and still only 10% growth, which was very interesting to me. Now, the last piece of the income statement that really spooked a lot of investors was the net income being down 45%. Now, this one is not as bad as it looks, because it was mostly due to one-time items, which was a one-time distributor termination fee. They pretty much spent like 80 million on this distribution termination fee. Now, if you adjust for the 80 million, they did 155 million in operating income versus 142 million in the quarter of the prior year. So net income in general would have been flat to up 10%. Still not really good, but it did not decline 45%. Now, if you look at the main issue within Celsius, is the core brand, the Celsius legacy brand. It was decelerating in growth, and this one, I believe it was the first time ever where this brand has declined 2% year over year in terms of sales. This is really bad. But what's even worse is that there was a reduction in the average SKU that's taking effect. The company claims they're making their ways to other brands, but a lot of the shareholders were not too happy whenever a company is losing SKUs and losing space in general. And the one that's not happy at all is the Rockstar Energy founder, which he's building a stake in Celsius, and he wants to fire the CEO, the management team. He wants to pretty much fire everybody. He said the CEO, the COO, the brand manager, and the marketing manager all need to be fired. He said, I'm publicly volunteering to do it. The CEO has lost credibility with the investment community. Now, this CEO of Rockstar, which now Celsius owns Rockstar, I think he has like a 4.5% stake right now in the company. And he has a very interesting story, because he started Rockstar Energy with like a $50,000 mortgage against his California condo. And he said he offered advice to Celsius over a year ago, but was largely ignored. He said Celsius has too many layers of management with too many costs and no real accountability. So he has a pretty decent background to be able to do all those things. I think if he can run Celsius, I think he could potentially do an amazing job. And he seems like he really cares about Celsius. He cares about his own brand, which is owned by Celsius, and he cares about the company in general. Now, I'm not sure if anything is going to happen. I don't think he has the ability to take a controlling stake in Celsius. His stake is like 4.5%, but some shareholders are upset and they might vote with him on certain things. So it will be interesting to see what happens with this situation. But I believe the management team of Celsius deserves some credibility, mainly because of the acquisition of Alani Nu. Alani Nu is growing 55.7% year over year. That was an amazing acquisition. Alani Nu is very popular amongst women. 70% of the users are women between age 18 and 44. Number 4 in energy in total. That was an amazing acquisition. When I acquired it, I thought they were overpaying, but it looks like they didn't overpay. And imagine how would the mix of revenue be looking like if you could say Alani Nu what wasn't within Celsius. Maybe Celsius would be like a $15, $10 stock in my opinion. So they did something really good with this acquisition. Now Rockstar Energy is not too popular. It's declining 13% year over year. And that's again a very interesting quarter for Celsius. Now, if we look at where Celsius is trading at, it's trading at about 19 times earnings. 19 times earnings is really low on a historical basis. The stock used to trade as high as 100 times earnings. I remember it was always that growth stock that never goes down, and it just kept going up and up and up. You could look at the chart. It was just an insane stock, one of the best stocks of all time. But from the peak, it's down like 70% from the peak. So that's an interesting story. But about 20 times earnings on a historical average is cheap, especially if you compare it to Monster Energy. Monster is trading at 36 times. This one is trading at about 19 times earnings. And Celsius is expected to grow earnings about 12% in 2028, 28% next year. So about, I would say, 15, 17% on average. I think they can easily pull it off, in my opinion. So if I look at my valuation model on Celsius, I have $1.46 for this year. Then I assumed 15% growth for the company. I think with a combination of some growth with Alani Nu, some international expansion, some price increases within the company, I think they should be able to grow at least 15% a year. But maybe the management team has demonstrated their ability in terms of capital allocation. So maybe they can take the free cash flow and buy a stake in some other Alani Nu 2.0 or some company that's also going to fuel the growth. So the company could potentially become an acquirer of a lot of those younger brands, as you always have change in those, you could say, fashion and drinks and all those discretionary categories. So if Celsius could do that, they would also boost the growth a lot. So I think they should be able to do at least 15%. Now, if they do at least 15%, they maintain a 19 times earnings multiple, which I think is fair relative to Monster, which is at 32 times. It stays at 19 times. I'm seeing 101% on the upside. What about a 15% annual return, or almost a double over the next 5 years? This is not a bad return at all for a company like Celsius. Again, remember that Celsius used to trade, not long ago, last year or earlier this year, it was trading at 36, 40 times earnings. So if you have this new CEO taking over and you have some major changes in the company, it could get back to the multiple. Now, if Celsius ever gets back to 30 times earnings, as an example, that would be like a 26% annual return or 217% upside over the next 5 years. So I think Celsius is undervalued. I think it's well priced for a lot of the risks that it's in. It's not, you could say, the most predictable business model out there because you have a lot of changes that's happening. You have Costco creating their own brand, which is a much lower cost, but people said it tastes terrible. So there's a lot of controversy around those competition to Celsius. But still, there's some competition. You can't predict consumer changes. And in this case, for the multiple of Celsius, I believe the stock is undervalued. Now, the second stock that a lot of you guys have asked me about is AppLovin. AppLovin is down 44% over the last year. When I look at a growth stock, I normally look at the revenue growth. When I looked at the revenue growth of AppLovin, I was very impressed. I was very surprised. The company grew 75% in 2024, 70% in 2025. This year, they're growing 60% in revenues. This is massive growth for a company's chart that looks like this. It looks like the company is going out of business. But what surprised me even more is the company's discipline in capital allocation, in their stock-based compensation, in maintaining their shares, because all those companies that are growing so rapidly, they normally have a lot of dilution. But AppLovin's shares outstanding have been actually flat to even going down a little bit, which is really good for a company that's growing 70 and 75%. Now, the stock-based compensation is also in check. The company is making about $1.2 billion in net income. Their stock-based compensation is only $85 million. So this is an amazing ratio that very few companies can put up. And by the way, I'm using fiscal.ai to come up with all those charts. If you want to try it out, they give you 15% off if you want to use my link in the description. But what also impressed me about AppLovin was, you could say their discipline in terms of cost. So I look at the company's income statement is 1.2 billion in 2025. They put up 1.9 billion dollars while maintaining G&A, and it's been actually going down. So their administrative costs and general and employees and a lot of those employee expenses, you could say, it went from 55 million to 40 million while expanding revenues from 1.2 billion to 1.9 billion dollars. That was very, very impressive to me. And I was really curious on why is the stock going down. So I looked at the company's report. It wasn't really bad. The company met earnings per share estimates, but the revenues, they pretty much missed on revenue by like 200 million, which isn't really the worst deal in the world. Now, a lot of the analysts, they downgraded the company. They slashed the target from $665 to $385 per share. They said, we remain impressed by management, the business, and their market position, but we have more questions than answers on the beat raise cadence from here and move to the sidelines. And if you look at what the analysts are pricing in, they're pricing in a pretty much massive deceleration in AppLovin's revenues. And once you have a growth company that starts to decelerate in revenue growth on a quarterly basis, sometimes the market is forward-looking and they try to price it into the future. I think this is what could potentially be happening with AppLovin, as the company is expected to go from 58% growth all the way down to 30% growth by March of 2027, and is expected to end 2027 at about 20% revenue growth. So this is a massive deceleration from 70% to 20%. The market wants to price it in. The stock overreacted and it went down like 24% on the year. It went down a lot over the last few days. And the stock is down so much that despite all those growth numbers and despite all those margins, the company is still trading at about 18 times earnings. 18 times earnings for such growth, even 20% revenue growth, not 70, just 20% revenue growth. Such margins, such discipline, stock-based compensation. This is near its historical bottoms that it had before. And I personally believe that it's looking like an amazing setup for a company like AppLovin. So I think AppLovin to me looks undervalued. I'm personally not buying AppLovin because I don't feel comfortable with the business model. I only buy things that I can easily understand, that I clearly understand, you could say, as much as I can. And I try to understand AppLovin's competitive advantage and some of the risks they're facing. And I had some difficulty really understanding it and feeling comfortable with it, which is why I am skipping AppLovin. Just like I skipped Zeta. I told you guys Zeta was looking like a great setup on the numbers, and it's been doing well this year. But Zeta was a stock that I also just never really felt comfortable with the financials and mainly with the business model in general, although the numbers look great. So this is why I avoided it. Now, my idea for today that I talked about before, and I think it's starting to gain some traction, is mainly around the rare earth metals and rare earth miners kind of trade. I told you guys about this a few months ago, and I talked about an ETF, which I'm going to talk about again. But now I think reality is starting to kick in for the Pentagon and for the government. They expect to pretty much won't have any magnet capacity by 2027 because China, again, is expected to curb the supply even more. And that's really bad for the United States government. But it's not just bad for the government. It's also bad for a lot of companies like Tesla and any company that wants anything to do with humanoids, physical AI, and all these things. Because all those things require those actuators, which is pretty much the motor that moves the hand and moves all those machines. And those actuators require a lot of rare earth magnets and heavy rare earth magnets. And China controls about 90% of the rare earth supply. So, the United States government has been investing in a lot of those companies, just like Intel. They're investing in them and they're backing them by long-term contracts. So before, what used to happen is China would come in and they would lower their prices. And once they lower prices, they bankrupt the US rare earth miners. But now the United States is signing 10, 20-year agreements with those rare earth miners, and they're giving them a floor, a minimum on how much they can charge, so China can't go on lower prices and bankrupt the miners. So this is a completely different setup that not a lot of people are talking about. But if you look at the humanoids trend and robotics, they need a lot of rare earth magnets. And Elon Musk said that they want to deploy like 10 billion robots by 2040. Now, even if you take half this amount, it's still huge. But let's assume he could potentially pull it off. It would require global production of critical inputs like copper, lithium, and rare earth magnets to increase by multiples just for the robots alone. We're not talking about automation machines and other automated stuff. That's just robots alone. For the rare earth magnets alone, it would necessitate more than 100 times the current global production. For lithium, it would be about 10 times. So rare earth is in a really interesting spot. And if you don't believe Elon Musk, take 20% of that. So it would take 20 times more of the supply, or even 5 times more. We don't have any of that right now in the United States. That's why there's so much investment going into a lot of them. Now, I told you guys before that my favorite one for most investors that cannot analyze those rare earth stocks is the rare earth miner ETF. There's this ETF called VanEck Rare Earths and Strategic Metals. The stock is flat on the year. It was going down. I think it's a good opportunity, but still, the ETF is flat on the year. It gives you a lot of exposure to some interesting metals and interesting minerals in general, such as this lithium miner, which lithium will be required for robots, humanoids. They all operate on batteries. Then you also get Linus, which is a rare earth miner in Australia. They have a lot of rare earths and heavy rare earths, which is what the US military needs. They need heavy rare earths, and there's not a lot of it outside of China. So you're getting also some Chinese players as well, and you MP Materials, you get so many different companies in one ETF. I think this is what most investors should potentially look into if you're looking to get exposure to rare earths and critical minerals. And I personally believe the whole rare earth trade could potentially be bigger bottlenecks than memory, because everything that's going to happen in the future, all the automated cars, space exploration, all of them need rare earths, especially heavy rare earths that the United States doesn't have. And once you have such imbalances in supply and demand, I think we could see something even bigger than memory. But I'm personally invested in like a small cap, you could say a rare earth company, and a speculative position that I have in my portfolio. And I share everything I do in real time and all my trades and all of that in my group. And this is the link if you're interested. But I really hope you enjoyed today's video. Thank you again for watching. It was not financial advice. If you did enjoy it, please press the like button and maybe consider subscribing. So I'll talk to you in another video.